Today, folks, this is nothing short of damn astonishing. I mean, my accounts are up over $100,000 between growth and contribution since the bottoms of the April tariff war, and I really want to give in full transparency what my accounts actually look like. We'll look at my TFSA, my RRSP, but my God, whether you're talking about XEQT, VDY, the S&P 500, just from an equity standpoint, forget the dividends. We are now up 8% across the entire board. All of these indices kind of trading in tandem, which has become quite an interesting trend as fear and greed continue to be at the extreme levels, with price to earnings multiples trading at highs that people are calling an AI.com bubble. However, the earnings are here to justify some of that, as we've seen the S&P 500 recently started posting some earnings, with 80% of those companies so far beating analyst expectations, with tech so far coming into play being a bit of a mixed bag. A lot of the other stocks are doing quite well, but tech, man, we saw Tesla really offer some controversial returns, which I think most of us were anticipating, with Google absolutely crushing it, making me feel like I'm sitting on a rocket ship that is still hasn't exploded into its true valuation. We'll talk about that more in a moment here, but speculative is heating up. And I've told you guys, if you're in really speculative investments, take profit, diversify, build your wealth preservation, because Goldman Sachs issued a warning over a sharp rise in speculative activity driven by meme stocks, SPACs, and surging call option volume. This trend is flashing caution signs for long-term investors. And as the market heats up, we see people more comfortable with using margin. And we've talked about that in the tariff war. Margin came down quite materially, and now margin is exploding again, and that is usually a sign of an overheated market. I would still expect a correctional period at some point, but again, I'm a long-term cost average investor. Look at my damn accounts. This is one of the longest positions I've had in VO thus far. Again, I purchased a piece of real estate here in Toronto a couple years ago, so I've been rebuilding back my TFSA, some of my accounts, but man, I got 165 shares just in VO in this account, and we're up 45%. If we look at my TFSA specifically, I've been trading in here quite a lot this year, but with some really good gains. Like Take-Two Interactive, we profited 14% on. Google is the primary individual stock trade that I'm concentrating between all our accounts. You know, my wife and I, we've got over 200 shares of Google now, and we're pretty much up 10% across the board, double digits, because our average buy is pretty accurate to this account, where it's around $174 per share. But in this account, really nice to see a 10% gain thus far. VOO, I'm up 16% on the Canadian side of my accounts. VDY, my only exposure. VDI, my favorite Canadian monthly paying dividend ETF, I'm up 12% on, excluding the dividends. All juicy, beautiful things to see across the board. But the thing that I'm patting myself on the back for the most, there's two things I do very well. When people are freaking out, my family's calling me, it's a tariff war, the market's in full calamity, I just doubled, tripled down, man. Go back, watch those videos. We were throwing thousands of dollars at the bottom of the market. And now the best thing ever was me recognizing the value of long-term potential and, you know, looking backwards at performance of SCHD. And SCHD just underperformed my expectations over the last 3 or 4 years. And right at the coming out of the bottom of that tariff war, I said, you know what? I'm done with this. I sold all my SCHD shares. I liquidated 2,465 shares. Selling $62,000 worth, pivoted all of that into the S&P 500, buying 125 shares. Since then, SCHD is only up 5.31%. The S&P is up 15.35%, but in totality, with today, I mean, an accurate representation, according to the account, I'm up 16.24%. When you focus on total returns, you make intellectual decisions, guys. I'm not a trader by any means. I'm usually a swing trader with some individual stocks, but as you know, I held on to SCHD for almost 4 years, and it really underperformed my expectations. And you have to smarten up and own up and hold people and stocks and your investments accountable. If things aren't going in the direction you expect, hold them accountable. Change your strategy. I keep telling you guys, you can't judge anything on a one-year basis, but build the strategy out and look and reassess every few years. And if it's just not giving you the results you desire, pivot. Do what you think is appropriate, because my God, I just made an extra 10% return of just putting this in the S&P 500, again, negating dividends. I told you guys, we talked about this with option ETFs and so many other things out there. Dividends shouldn't be your core focus, or you're going to miss out on things like this. And this is the most boring style of investing imaginable, but damn it, it works. Now, XEQT is one of the newest positions in the account. I started buying it at the beginning of the year, and when I sold Take-Two Interactive, I did pivot some of those shares into here as well. So the cost average is much more recent, so I am only up 3% on it. This is not nearly as volatile as the S&P. I consider the S&P to be a a bit of a growth vector more than perhaps maybe, like a global diverse fund. So you tend to get more upside because of the concentration in tech. I told you guys, I don't want to buy the Qs. To me, I just want to hand select individual growth stocks because I think I can select the value better than perhaps the Qs are. That's still to be said. We'll see how it works out with Google, Meta, some of our individual tech companies. But for now, we're starting to cost average into what I call wealth preservation funds, globally diverse. This will scale over time. It barely makes up 3 or 4%, I think, of our combined accounts today. But over time, I would like to scale this into probably about a 15 to 20% in line with my VDY position, and keep S&P at about 50% weighting, and then get about 10% individual stocks. But we're not there yet. Over time, this will evolve as we take profit, shift things around. But XEQT in the same time frame is still up 11%, which is still double the performance of SCHD. So I love XEQT. I think it's an end-all be-all solution to most people's investing problems. If we take a look at the performers this week, I am applauding myself yet again that Google and Meta are some of the best tech performers out there. Tesla taking the biggest hit of all. But if we look at Google earnings, I don't think it's just in the valuation. A lot of people were complaining that Google didn't go enough up on its earnings, but it is up over 20%, just within the last few months coming out of the lows of the year. So I'm still happy with the rate of return we're getting. And again, I just feel like I'm de-risked with a company like this because their search isn't going away. It's starting to grow again, which is great. So search isn't, dying to AI and ChatGPT and all those other ones. YouTube's growing excessively. Cloud is growing excessively. It's an AI leader. I don't think you can go wrong. Not financial advice, just my opinion of my own. It's why Google is the largest single stock position we've ever taken on. And I'm really glad that I am not touching Tesla with a 10-foot pole. Once used to be my largest position, one of my favorited stocks I thought I could hold for a decade. You can't touch anymore, guys. I'm sorry. If you're holding this, you got to recognize the absurd risk that comes with a company that is losing market share, even though it's a growing sector, the EV market, energy generation. The company has no more profitable cash flow. It's down 89%, and they are going to be spending CapEx like there's no tomorrow on self-driving robotics, and they're not going to be funding it anymore from free cash flow. This company is nothing more than a high-risk growth stock that just gave up all of its growth, that Elon just can't admit there's an underlying problem that they need to address, and they think that's introducing a cheaper model car. But a cheaper model car comes with lower margins, and honestly, I don't think it matters because the company has a sales problem right now. If BYD can grow, why can't Tesla? And introducing more models doesn't mean more growth until they address what is causing their marketing problems. Debatable on whether that's Elon politics. I'll leave that up to you, but you have to recognize the underlying fundamentals for Tesla are absolutely deplorable, and I would be ashamed as a shareholder personally, which is why I don't hold the stock. But what's coming up this week, we'll see if, Microsoft, a lot of these stocks have rallied pretty excessively. We'll get Apple, Microsoft, so many great companies. Meta's posting. Meta's going to be the one I'm on the edge of my seat for, and I think it's going to do incredibly well. Why wouldn't it? I'm still playing VR all the time, guys. I'm in the best shape of my life. Like, I'm honestly shocked shirts don't fit anymore because I just been playing VR now for 3 or 4 years, 3 or 4 days a week. Wear like weighted vests and stuff now. It's one of my favorite things to do. I used to be big into paintball, used to love just airsoft, and I can't go out and do it enough. But with VR, I feel like I can turn my entire room into like basically an airsoft game, right? Playing like Population 1, like their version of what you'd say is Call of Duty or Fortnite, and I've become obsessed with that over the years. And so I applaud Meta not only for their earnings, their resilience. I love their products. I'm going to be holding that stock, the longest standing stock position, I think, with the wife and I, because I used to hold it. She owned too big of a position, so I scaled it down a bit. But it is the longest single stock position that has ever stood in our accounts, and it's still going to be here, guys. It still fundamentally deserves that place. So we'll see how things go with that moving forward. If we pivot to the Canadian side of the border, we're still quite amazed, and I told you guys, if you wanted to trade it, non-energy minerals have been the place to be for as long as commodities trade up, and they're continuing to do well again, I think, on the back of silver rallying. Gold's been holding kind of flat here, but silver's been, propelling to new highs, which I think has got a lot of the commodity investors super excited again. Copper has been holding new record highs. There is something peculiar going on in the commodities market, and the miners are absolutely benefiting by leaps and bounds as we basically see in this chart. But we are going to head into some earnings in Canada in the coming weeks. So subscribe, stay tuned for that, because obviously TD, Royal Bank, very excited to see what those look like, being massive weighted positions in VDY. Otherwise, I feel bad for a lot of people that are playing kind of, the transportation, communication starting to come back with TELUS. But man, what happened to CP, CNR? These were quite incredible recession-proof like companies, and they're just getting absolutely clobbered. And I'm here to tell you they may be a buying opportunity as the price to earnings multiple now drops to the 17, which we haven't seen in a while, materially trading off those highs by about 27%. And this is all on the back of trade war fears. It's what's really hindering the company, and it's causing a shakeup in guidance. And, the market's forward looking always. And we saw that with the chip maker ASML, the company that makes the lithography machines. They tanked pretty bad on earnings, even though earnings were great. They couldn't offer guidance because of, trade concerns, geopolitics, and that's enough to tank the stocks, but does open up quite a nice little buying opportunity. Again, this is the highest dividend yield CNR has basically ever paid out through its entire history of a publicly traded company, which is quite an astonishing thing to say. So, I mean, you could look at this as a buying opportunity if you believe in this company long term, but I'm here to tell you the fundamentals still remain quite strong. Their earnings are a bit flat year over year. I think revenue was down 1%. They were able to increase cash flow slightly. Nothing crazy. It's not like a massive growing company here, but fundamentally, I still think it's relatively strong. It's just guidance is going to deteriorate it. So if that's a buying opportunity to you, I would consider it if you like these kind of companies. It's not one for my personal taste, but I do recognize that there's a lot of dividend companies like Hershey, Nestle, Pepsi, so many great consumer staples are trading down at pretty discounted levels if you believe the future is still going to be strong for them. So if you're a dividend investor, these could be some good dip buy opportunities. However, I'm still going to focus on where I see the best value, the best growth, and that's going to be in some of these tech companies. But at this point, I will pass the question off to you. I'd love to know what you think about the markets in general. If you're thriving in this kind of environment, I hope you are. I hope you're learning from this channel. I'd just love to hear how you guys are doing and what you're buying, all in that comment section below.